Hello. In this video, we'll be discussing IFRS 9 financial instruments with an emphasis on the classification at initial recognition, measurement at initial recognition, remeasurement, subsequent remeasurement, and impairment, including ECL. I'll tend to focus mainly on having practical examples and to see the application, to see the debits and credits, to see the numbers. So it's not just theory. So I'll focus more on the application, the examples, the debits and credits, and then we can look back at the theory and the verbiage of the standard. So let's go. One of the reasons IFRS 9 was issued was to address the criticisms of IAS 39 at the time, saying that, okay, it was too complex, inconsistent with how the entities manage their businesses and risk. So the aim of IFRS 9 was to improve the accounting and reporting of financial assets and liabilities. So in terms of the financial assets, we will have two main types: the equity instruments and the debt instruments. So what's the difference between the equity instruments and the debt instruments? We'll start with the equity instruments. The keywords here are representing a residual interest. So what's the meaning of a residual interest? The equity holders, the equity shareholders, they are not going to be entitled to receive anything just in case of liquidation or something of the company until the creditors have been paid first. So, for example, a bondholder, which is a liability to the company, is going to be paid first before paying anything in case of liquidation or so to the equity shareholders. And we will have a deeper look at the the debt instruments later on after discussing the equity instruments. So in IFRS 9 came with a model here that in most of the cases, equity instruments are going to be valued using fair value profit or loss. So fair value through profit or loss. And from its name itself, this means that changes in fair value are going to go directly to profit or loss, i.e. the income statement. Pretty straightforward, I hope. As let's have a look at an example, as I said earlier, which makes it clearer and clearer. So the company here acquired 5,000 ordinary shares in the investee at a price of $20 per share. The company doesn't have significant influence over the investee, which means that in case of significant influence, but this is beyond the scope of this video, you'll have to use the equity method if you have a significant influence over the investee. But here, as the company doesn't have significant influence, we will be using IFRS 9 for the financial assets, and these are fair value through profit or loss, as we said earlier. So when the company acquires the share, they debit an investment. We're just clarifying here that this is going to be fair value through profit or loss. So for $100,000, what this means, it's 5,000 shares multiplied by $20 per share, give us 100,000, and credit in cash, pretty straightforward. That's the initial recognition at the cost paid, which should be like the fair value on that date. So let's go to the subsequent measurement. So let's say the price of the share increased to $22 from 20. So it's like a $2 increase. So $2, 5,000 shares. So 2 multiplied by 5,000 give us 10,000. So we write up the investment. We increase its value in our books by $10,000. And the credit goes directly to profit or loss. So whether we sold it, not sold it, here's just a holding gain, i.e. unrealized gain, still it goes to profit or loss, to the income statement. So let's say here later on the company sold half of the shares, 2,500, for $23 per share, which means an additional $1 increase. That's good news. So easily understood with the double entry, just debiting cash for the amount received, which is $23 multiplied by 2,500 shares gives us 57,500. We close the amount that's sold, we derecognize it, so we credit the investment 55,000. And how we got this 55,000? It's the net book value on that date, which was like 100,000 initial recognition and then a write up of 10,000, so 110. This is all the shares, the 5,000 shares. We only sold 2,500, so half of that, so half of 110 is 55,000. This is the net book value since the last remeasurement. So we have an additional gain of 2,500, which again goes to the profit or loss. And here we can see this is a realized gain, i.e. this is an actual, not just a holding gain, as we already sold the shares. But however, this doesn't make any difference. It still goes to profit or loss. So realized gains, unrealized gains, whether it is due to sale or holding of the asset, still goes to profit or loss directly. So again, as we see here, we also need to revalue the shares that we are still holding, the unsold shares. So we sold 2,500, we're still holding another 2,500 shares. The latest revaluation was at 22, price now is 23. Let's remeasure that, increase the investment by 2,500 to just increase by $1, multiplied by the shares that we are still holding, 2,500. So write up the investment, increase it by $2,500, and again the credit goes to the profit or loss. So whether we sold it or not, it's still going to profit or loss. Pretty straightforward, I think. And that's it for equity instrument valued at fair value through profit or loss. Okay, let's move on to the second option related to the equity instruments. So this one is fair value through OCI. And let's have a brief overview of this one. Some of the companies said, like in their comments at the time, okay, we don't keep following up the changes in market price for the shares that we have acquired, like on a daily basis, monthly basis. We're not speculating, we're not acquiring these to make short time profit, i.e., these are not for trading. These are acquired for, these are the two keywords here, like strategic alliances. And what's the meaning of that? Let's say, like a manufacturing company that is requires lots quantities of fuel or natural gas to run its equipment and so on. So they're having like a 10% share in one of the main suppliers of natural gas, for example. So they are buying these shares for strategic alliances reasons. They are not just acquiring these shares to make a quick profit or to trade them when the price increase and to sell them to make a profit. So what IFRS 9 came here with was a solution to that, but it has some bit of strict conditions. Let's say, so IFRS 9 said if you want the changes in fair value, the unrealized holding gains, and even when realized later on, to go to OCI, not to profit or loss, you have to make such election at initial recognition, and it is irrevocable. So if you make this election, you will have to recognize all the changes in fair value of these shares in OCI, and these are never going to be reclassified to profit or loss, whatever happens. Even if these shares are derecognized, sold, impaired, everything will still be in OCI. So that's the irrevocable election that the company have to make at initial recognition. Again, easily this shown in this example is gonna be very similar to the previous one, but just the changes are going to be changes in fair value, and gains and losses are going to go to OCI instead of profit or loss. Let's see that. So still the 5,000 shares acquired at $20 per share. So these are the 100,000. Same entry, no difference. But then let's see the first change in fair value. It's increased from 20 to 22. What happened? $2 and a gain. So investment is debited for $10,000, which is increasing the share price by $2 multiplied by 5,000 shares. Instead of the credit going to profit or loss, is gonna go to OCI for the 10,000. Again, even when we sell these shares for $23 as we saw before in the previous example, still we're debiting cash for the 57,500, would be crediting the investment for 55,000 as we saw before, and still this gain of 2,500 is going to go to OCI, not to profit or loss. So again, everything is going to OCI, even when this gain here is realized, because this gain resulted from a sale of shares. So still it goes to OCI and not through profit or loss. This 2,500, and we have to revalue the unsold shares, the other 2,500 shares. So we debit the investment for 2,500 and credit the OCI again for 2,500, and all of this is staying in OCI, and it will never ever flow through profit or loss, even when sold, as we saw here in this example. So let's have a look at the verbiage here and see how it is discussed. So all gains or losses go to OCI even when the shares are sold, i.e. the gain is realized. So under this option, usually the qualifying dividends, if you receive dividends, that's the only thing that's going to go to profit or loss. That's normal accounting. You're receiving a dividend on an investment that you have, you're debiting cash or receivable, and then you're crediting dividend income, which goes to profit or loss. So the changes, but we're more interested here in the changes in fair value. Changes in fair value are recognized in OCI and never reclassified to profit or loss, even if the asset is impaired, sold, or derecognized. However, just a small point here, that IFRS 9 permits the changes in fair value of investments in equity instruments designated at fair value through OCI to be transferred directly from accumulated OCI to other equity accounts, such as retained earnings on the sale of the investment. So what this means is this 2,500 that's now realized on sale, the company has which goes to OCI, the company has an option to transfer this to retained earning, but not through profit or loss. So the entry is going to be like debit the OCI, credit the retained earnings directly. So that's going to be a reclassification amongst equity accounts. It's going to appear in statement of changes in equity, not in the statement of profit or loss, not the income statement. It is going to be just change in equity. Okay, we are done now with the equity instruments and I'm going to be moving to the debt instruments. And as we discussed in the equity instruments, let's see what differentiates this from the equity instruments. Legal obligation. So the debt instruments are fixed income assets that legally obligate the debtor to provide the lender interest and principal payments. So, as we said before, here there is a legal obligation on the company, the investee, to pay back the amounts to the debt holders. So, to pay them back by principal, any interest, and so on. And this is a legal obligation. Distributing dividends, on the other hand, to equity shareholders is not a legal obligation. So, this is the main difference. So the investments in debt instruments, we'll have three ways to measure it. Amortized cost, which in my opinion is going to be the main option we're going to be looking at, and then fair value OCI and fair value profit or loss. And we'll start by the amortized cost and then see how the other two differs from the amortized cost. So mainly we'll be looking at the amortized cost model and then go through the other ones. I'll come back to this verbiage later, but let me have a look at again at an example, as I usually tend to do. We'll have a look at the example and then go back to the verbiage. Here the company acquired $100,000 bond. This is the face value, and they paid 97,500. So what this shows us initially that there was a discount of 2,500. So again, the company has investment in $100,000 bond, face value 100,000, just paid 97,500. So it appears that there is a discount of 2,500. And let's say here, why is something issued at a discount, like in this case? So this was done to facilitate the sale. Why to facilitate the sale? Let's see here, for example, the coupon rate, the stated rate on the bond is 4%, which is paid annually on December 31st. However, there's something called the effective interest rate here, which is 4.9165. So what this means is that, like, other bonds may be in the market giving a higher rate than 4%, giving something that like this 4.91. So the market rate is higher than the stated rate, which is 4%. Sorry. So accordingly, the bond is issued at a discount to give an effective rate, or a yield rate is also called, of 4.9165. And again, easier shown in this example. So let's say, I assume most of you are familiar with this four-column approach that's used mainly to calculate the value according to the amortized cost method. But it's going to be hopefully pretty straightforward. This is bought at 97,500. This is what we paid to acquire the bond, the investment. It's the interest income calculated at the effective interest rate of 49165. Annually is going to be 4794, sorry. Think of it as like an investment or a saving account or something. So you invested this amount, a full year has passed, you are entitled to an interest at this percentage, so it's increasing the value of the money in your saving account. However, you withdrew 4,000 here in this case, which is the coupon rate, the stated rate, which is paid annually. So the bond issuer have to make such annual payments, and you always gonna be stated rate multiplied by face value. So nothing related to the effective interest and or the discount here or so on. The cash paid by the issuer, received by the investor, is always going to be the face value multiplied by the coupon rate, the stated rate. So think of it like a withdrawal. So we have accrued interest, but we withdrew like 4,000 of it. So we get to an ending balance here of 98,294, which is going to be the beginning balance of the next year, and so on. It's going to earn interest at 49165, which is this, and then they're going to pay us 4,000, and then we start. That's the ending of the second year, and then we use it to start the third year. Then it will earn interest at 4.9165. So that's it. And accordingly, we get a payment of 4,000. And then the ending balance, the 100,000, is the amount that the issuer has a legal obligation to pay it back to us at the end of this life of the bond. So it reached maturity now. So It's always paying the face value. So let's focus here on this. Interest payments are the face value multiplied by the stated rate. Payment of principal at maturity is always going to be the face value. So you always pay the face value. The bond issuer will always be paying the cash using the face value. So this shows us, by the way, how we got the effective interest rate of 49165. So if we are not given that rate, so that's the rate that makes this constant yield and makes the amount that's going to be payable by the issuer at maturity 100,000. So this is another way to know how we got this 49165. So another point that we're going to be looking at when we look at the verbiage, these payments are constant payments of 4,000. Aren't these interest payments? Yes, they are. Okay. And this 100,000 that's going to be paid at maturity, isn't this the principal payment? Yes, it is. So, accordingly, aren't these payments solely payments of principal and interest? These are solely payments of principal and interest. And this is the terminology that we're going to see when we look at the standard itself and when we can use the amortized cost method. But let's keep going. Here we can see the discount amortization. This 2,500 is the difference between what we paid and what we are going to receive at maturity. Here we see the discount that's amortized annually. It's the difference between the payments received, the cash received, which never changed, and the interest income that's calculated using the effective interest rate method. So 4794 minus 400 gives me 794, and so on. We can see it's the difference. And this is how we amortize the discount to reach an amount of 100,000 that we are going to receive from the issuer at maturity. Sorry. So how do the double entries look like? Again, it's pretty straightforward here. If you just use the table and the acquisition, just debiting the investment, we are designating it here at amortized cost, and we'll see when we can do that. 97,500, and we credit in cash for 97,500. Interest payment, year one, we're gonna receive cash, which never changed of 4,000, so that's gonna be easy. Debit cash of 4,000, and we have to credit interest income based on the effective interest rate, not what we receive. So we're crediting interest income, which goes to profit or loss at 4794. Sure, the entry doesn't balance. We need another debit. This debit is the discount amortization of 794, which increases the investment till it should reach 100,000 at maturity. So this is how the double entries go. That's just the first year, second year, third year. Same logic, same methodology, using the numbers in the table, and so on. So, as I mentioned before, when can we use the amortized cost? Let's look now at the verbiage. So what the IFRS 9 said, that the classification measurement is based on what's called the business model. What the business model is saying, it's saying what is the aim of acquiring such debt instruments, these bonds, for example, we're mainly focusing on bonds as the main example of debt instruments. Are we holding these bonds to collect cash or to sell it in the market? So let's go to the business model first. So what's the objective of holding it, as I said, is to collect cash flows or to collect cash flows and sell. Or maybe later we'll see, or just to sell, mainly to sell. So it's saying here, what is our business model? Is it held to collect or sell, held to sell? If we are holding it, so, so that's the first point. The second point is the contractual cash flows. Other contractual cash flows give rise to payments on specific dates, as we saw in our example, that are solely payments of principal and interest, SPPI, as we mentioned. So that's the SPPI test. So let's say if we have a bond investment in a bond, and we are receiving such payments on specific dates that are solely payments of principal and interest, and we are holding it to collect cash flows, i.e., let's say to maturity, then we can use the amortized cost. So here we have this table that summarizes. So if it is held to collect, i.e., to maturity, so we can use the amortized cost. And how about the sales? Sales here are incidental. It doesn't preclude us of selling the investment, but saying this is gonna be the exception. This might happen incidentally, but it's not gonna be the main case. So again, if we are holding the asset to collect cash flows to maturity, and sales are incidental, have to be incidental, then we can use the amortized cost method. So, but some companies say, okay, we sometimes acquire the investments in bonds and hold it to maturity, and sometimes we sell it. Maybe they are managing some concentration risks. For example, we are having lots of investments in a certain company or a certain industry. There's some kind of an increase in risk related to the issuer, so we tend to sell it, and this will help us again when we're looking at the ECL. Or there are some changes in market conditions, like interest rates are dropping, the interest stated on our bond are higher, the bond price increased, we can sell it to make some profit. So we have like a mixed portfolio here, but we sometimes sell, we sometimes hold it to maturity. So in such case, we can use fair value OCI, and we will look later at this and see how it's there's some additional entry. We'll keep doing the same accounting as in the amortized cost, and then we'll have just one entry to record this change in fair value, which is going to be reflected in OCI. If it doesn't meet any of this, and just we are acquiring some investments to trade, like sales are integral, this is the main aim, the main reason we are acquiring such bonds. We usually buy and sell to make profit, like speculation here. So in such case, we use fair value, profit or loss. So let's go back to our example after we have looked at the verbiage and see. Hopefully, we understood these terminologies of the standards, like solely payments of principal and interest, business model, collecting contractual cash flows, and so on. So we have done the entries here for year one. As we mentioned, like we still have the credit risk. The IFRS 9 now says, okay, you have to make an allowance for risk related to amounts not going to be collected in full. So what happened here in the expected credit loss? Let's link it back to what happened like in 2008 when the financial crisis happened, saying some loans were not paid and so on, and then okay, the company said, oh, we didn't expect that was unlikely to happen, it was like a remote possibility and so on. So the standard, this is why we came with the terminology now, expected credit loss. We need to expect, to anticipate how credit loss might be. So this also tends to be forward looking, looking at the future, not just an incurred loss model that is mainly relying on what has already happened. So what's happening here, like saying, okay, make it easy. Let's say, oh, this loan, there's some possibility that it's not going to be paid in full, which is like 2%. So traditionally, because in the past we say, oh, 2%, this is going to insignificant, immaterial, this is very unlikely, ignore. Now, according to IFRS 9, saying, okay, you need to book this as an allowance, a debit to profit or loss, and a credit to the allowance. And you keep revising this allowance year on year and so on, or when there is a reporting date. So you need to keep revising the amount in the allowance. So again, easier understood with an example. So let's see here what say the entities will have to create an allowance for possible future credit losses when a loan is recognized, even it is highly likely that the loan is going to be paid in full. So why is that happening? Again, because every loan and receivable has some probability of defaulting in the future. Every loan has an expected credit loss associated with it. How is this? Let's say we have here a few scenarios that we are going to be looking at to make it easily. Let's say it can be more complicated in reality in having more and more scenarios, but let's say see here saying there is an expected loss of 50,000, i.e. half of the loan is not going to be paid back, which is it was 100,000, so here 50% is not going to be paid back. That's 3%. 75%, 75,000 is not going to be paid back. This is 1.6%. The full 100,000 is not going to be paid back, which is 0.3%. So what happens here? Multiply each expected loss by its probability, gives us an amount. Sum of all of this amount, this is our expected credit loss. So this is what's mentioned here when we said that under the expected credit loss model, an entity calculates an allowance by considering on a discounted basis the cash shortfalls it would incur in various default scenarios. So we have various scenarios here for future periods by multiplying this shortfall by the probability of such scenario. So here are the scenarios, probabilities, multiplying, we get an amount. The allowance is going to be the sum of these probability weighted outcomes, which in our case is 3,000. Again, as we said, because every loan has some risk associated with it, then we need to recognize this. And this, by the way, one of the consequences of this is like increasing the volatility now related to the income statement. So we will have this loss of 3,000 this year. Highly likely the bond issuer is going to be paying the amount and so on. So we might have to reverse it in the future, and it's going to be reversed as a gain. So we're going to, when we no longer need the allowance, we're going to be debiting the allowance, crediting the expected credit loss, or having a gain. So if we don't need it, then that's it. So in this example, we see that we have calculated this based on 12 months, the following 12 months, and this is what we call the general approach of the expected credit loss, the general approach. So let's see when we can use this general approach and look at the next 12 months only. So the critical factor here is whether the credit risk of the loan has increased or not, significantly increased. If it's not significantly increased, we do this anticipation for the next 12 months only. If it has significantly increased, the company will need to make this assessment over the full lifetime of the bond, which is in our case like was 3 years. If we have like another bond for 5 years, 10 years, you'll have to make this assessment and this calculation of the allowance based on the full lifetime, which is a bit more difficult, I think, because you need to anticipate more and more in the future. Like after 3 years, 5 years, 10 years, it's going to be more difficult than just make this expectation for the next 12 months only. So let's continue with our example and see how this is going to be appearing in the statement of financial position on year one. So that's the bond. We acquired it at 97,500, which is the cost. How we got this, here it is, and the example. That's the amount paid. Here is the acquisition entry. So it's 97,500, and then it's increased here by the discount amortization of 794. This is gonna be reflected in our calculation as well. So initial recognition, then we have a discount amortization, increased it to 98294. We had to calculate an allowance for credit losses, 3,000, and we saw how this 3,000 was calculated. Here it is, some of the scenarios, probabilities, getting a sum. So this is how we got the 3,000, and that's the net book value. That's gonna go to the statement of the financial position, the balance sheet, 95,294. So this is how it is done according to the amortized cost. Let's quickly move now to the other one, the fair value through OCI, which is not that different. This is why I started with the amortized cost. You'll do the same accounting as per the amortized cost until you have reached a balance of 95,294, and then you'll go and compare this to the market value. That's it. So let's say the market value December 31st year 1 was 95,000. So again, it seems based on our amortized cost working, we reach a balance of 95,294. So it seems there is a loss of 294, and this loss, right ups, right downs, right down here, goes to OCI if we are using a fair value through OCI. So it's just one additional entry. We debit OCI for 294 and credit the investment by 294. So now the balance of the investment is going to be 95,000 according to the fair value OCI method. And again, a reminder, when can we use the fair value OCI method instead of the amortized cost? When our portfolio is held to collect and to sell. So what we sometimes sell, we sometimes hold the bonds to maturity to collect the contractual cash flows. So it seems like a mixed portfolio. We sometimes sell, we sometimes keep the bond and hold it to maturity. So we reach here a balance according to fair value OCI of 95,000. Okay, let's follow up with the example and see. Okay, the company decided to sell the bond now at $95,000. So it's going to be debiting cash and crediting the investment in bond for 95,000. And what makes it here different, the fair value OCI in debt instruments, if we compare it to fair value OCI of equity instruments, that this amount of 294 that was in OCI and went to accumulated OCI can be transferred on sale, or i.e. when the loss or gain is realized, can be transferred to profit and loss. Or it's not can be, it has to be transferred to profit and loss. So because here it is sold, we debit in cash, crediting the investment, derecognizing it at 95,000. The loss that is in OCI has to be reclassified to profit or loss. So we debit a loss on sale of 294 and credit OCI for 294. So the balance in OCI related to this one now is 0 because it has been sold. So with the rule here, what does it say? when the asset is derecognized, which is means sold or something, or reclassified. Reclassification wasn't part of the scope of this video, but again, yeah, when the business model change, we need to reclassify it. Like if we are like something designated at fair value OCI, so it means held to collect and sell. But if we are not selling, for example, it seems like in 95% of the cases we are holding these bonds to maturity. Sales are incidental, so you need to be reclassified to amortized cost to be using the amortized cost method. Or on the other hand, if we are acquiring these bonds and nothing is held to maturity in the portfolio and we keep selling quickly to make short time profit, then this seems to be like trading. You need transferring to fair value profit or loss. So in such case, if there is a reclassification or change in the model, all the amounts accumulated in OCI, previously recognized in OCI, and accumulated in equity section, because accumulated OCI is part of the equity section, this have to be reclassified to profit or loss on a basis that always results in an asset measured at fair value OCI having the same effect on profit or loss as if it were measured at amortized cost. What does this mean? It means that if we go at these examples and look at the total of effect on profit or loss when using the fair value OCI method, it should be equal to the effect on profit or loss if we used the amortized cost method. So let's see what happened here when we use the fair value OCI. So in the fair value OCI, we having let's see, this allowance, it by definition goes to profit or loss. What happened here? The amounts of this unrealized loss that was in OCI, it's 294, but on sale it was reclassified to profit or loss of 294. If we go to the amortized cost and have a look at what happened and see, it was the same main entries used, again the same entries. These are applicable to fair value OCI as well. The interest income in all cases goes to profit or loss if we're using the amortized cost or OCI. The ECL also went to profit or loss, as we said. If we sold the bond when we're using the amortized cost, what the balance here is, it's 95,294. If we sold it at 95, we'd have a loss that goes to profit or loss of 294. What happened here in OCI? Initially, on revaluation, we put this 294 loss in OCI, like temporarily, until if it is sold, it's going to be realized and moving to profit or loss. So if we calculate the same effect, the effect here using the fair value OCI is going to be equal. On profit or loss is going to be equal if we used the amortized cost method. Let's say if we didn't sell it, what's going to be happening? We're going to be collecting the 100,000, the fair value. The face value. We'll be collecting this at maturity. So anyway, if there are write-ups and downs that are sitting in OCI, these are going to be reversed because they are not going to be used. We're just going to be receiving the amount of 100,000 at maturity. So any amounts in OCI are going to be reversed. We will debit or credit the OCI and debit or credit the investment to reach 100,000. So nothing in that has accumulated in OCI is going to be relevant in such case. So again, no effect on profit or loss. All the effect on profit or loss using amortized cost method or fair value OCI is going to be the same. I hope these examples have been helpful in clarifying the picture and makes it easier to understand how the accounting for debt instruments is. I hope you have benefited from this video. If you have benefited, you think you have benefited from it, share it with your friends and anyone you think is going to be benefiting from it. Spread the word, and thank you very much indeed for your time, and see you in another video. Thank you.